Hi all of you, I welcome you all for Shanmugam IAS Academy. I welcome you all to current events of the day. The topics for today's discussions are: Lok Sabha gives approval for National Capital Territory Bill, present status of Stand Up India scheme, India not a part of Troika-plus-Pakistan conference, which has been conducted by Russia. A cabinet clears 74% FDI in insurance sector. Fine, let us take up the first one, that Lok Sabha gives approval for National Capital Territory Bill. Lok Sabha passes a National Capital Territory of Delhi Laws Second Bill 2020. So this is a second amendment bill. So here we have to focus on the second amendment and we have to see what has been in the first amendment. The bill amends the National Capital Territory of Delhi Laws Second Act 2011. It was the first one, 2011, which has been amended. The 2011 Act was valid till 31st December 2020. So the second amendment seeks to extend this provision until 2023. So what is that bill seeks? Two qualifications. First, that existed in National Capital Territory of Delhi as June 1, 2014. The unauthorized colonies are there in Delhi. So these are the two qualifications. One is the National Capital Territory of Delhi, in which the unauthorized colonies has existed from June 1, 2014. And the second one that had seen development up to 50% as January 1, 2015. So the bill totally based on unauthorized colonies of people. It also provides protection to certain forms of unauthorized developments in Delhi from punitive action where adequate measures are yet to be taken. So this bill also seeks this provision. So what was the need for this bill? There are 1700 unauthorized colonies in Delhi. Due to unauthorization, these colonies are not receiving proper amenities. So to give them a proper amenities for the colonies, this bill seeks an amendment and this is going to be extended until 2023. We are studying this here because NCR, that is National Capital Region, is very important. The amendment bill also very important. So please have a look on it. So let us take up the next one, that is present status of Stand Up India scheme. Stand Up India scheme is a scheme which has been implemented by the central government to develop entrepreneurial activity by the SC, ST and women. So what this scheme, as per the government says, the government has informed the Lok Sabha about the implementation of the Stand Up India scheme. More than 81% of the accounts under the Stand Up India scheme belong to women entrepreneurs. So more than 81% are women entrepreneurs, even though it is given to SC and ST, in which male persons or entrepreneurs comes under. About the Stand Up India scheme. The ministry, which ministry has launched? Department of Financial Services under the Ministry of Finance. What is the objective? It is having the objective to develop the entrepreneurship in manufacturing, service, agriculture activities and allied activities or trading sector by SC, ST and women entrepreneurs. So bank loan, here to develop entrepreneurship among the SC, ST and women, the government is supporting and facilitating the banks to give loans, but they are not funding actually. These loans have to be repayable, have to be repaid to the government in which they have borrowed. They are extended by scheduled commercial banks. So SCBs are giving these loans. Eligibility condition for Stand Up India scheme. So SC, ST and or women entrepreneurs above 18 years of age are eligible to get or gain from Stand Up India scheme. Loans under the schemes are available only for greenfield projects. So anything which affects the environment will not be given with loan. So the actions and the activities of projects should be based on greenfield only. So greenfield signifies the first time venture of the beneficiary in manufacturing, service, agri-allied activities or trading sector. As we have discussed earlier, these are the only things for which the banks lends. In the case of non-individual enterprises, 51% of the shareholding and controlling stake should be held by either SC or ST under women entrepreneur. So if there is no one individual enterprise or individual entrepreneur, his share should be, the borrowing share should be 51%, either by the SC or ST and women candidate who borrows from the banks. Borrower should not be in default to any bank or financial institution before so some credit points you should have. If you have got any housing loan or any kind of loan from any other banks, you should be repaid and you should be paying the interest for the loans you have got. So these are the qualifications you should have to get this loan from Stand Up India scheme. So what is the repayment period? It is repayable in 7 years with the maximum moratorium. Moratorium period in the sense the period which is given to repay the loans, or the time period which is given by the banks to repay the loans the borrower got. It is up to 18 months. Duration of the scheme: the Stand Up India scheme has been extended up to year 2025. So still we are having 5 years to go. India not a part of Troika-plus-Pakistan conference. We know that Afghanistan facing a major peace problem. So in which Russia having a interest to consolidate and compromise the problems between Afghanistan and Afghanistan government and the Taliban people. So we cannot say that Taliban terrorist as per Afghanistan says. We are studying about Afghanistan's peace process. So the Taliban and Afghanistan are the two separate individuals who are facing a major distraught between them. So this is the second meeting which is going to be held in Moscow, Russia, in which US, Russia, China and Pakistan, and along with the representatives of Pakistan, also Afghanistan also going to participate in this conference, in which India is not going to be participate. What Russia says about is India is we are conducting this in a regular manner as we do conduct in previous days. We are not neglecting India. There is no any discrimination, voluntary discrimination or obligation from our country. We are doing this as usual. So we are not neglecting India. We are doing as per the last conference. So India was not a part of in the last conference. So India has been not neglected. It has been dealing with the actual program. So Biden's Afghanistan peace plan. So as per the Doha agreement in which US has signed, we are not going to we are going to give our May 1, and after that 2021, this is May 1 2021 is the time period to have US troops in Afghanistan to curb the terrorist activities of Taliban and to protect the Afghanistan people. So the US has been funding for this Afghanistan to protect the Afghanistan from Taliban. So now this process has been taken up to Turkey by US to convene the meeting by Afghanistan to control the peace process. So what's the Taliban to reduce violence? The United States has asked Taliban to accept an immediate agreement to reduce violence for 90 days. So we have to wait for 90 days. We should not do any violence against Afghanistan people. Please wait for 90 days. We will be giving a good conclusion. What is this conclusion? US says to the Afghanistan government, we are taking our troops, so we would like to have peace in your demographic. So what we are saying, 50% of the government will be run by Afghanistan president and the 50% of the government will be run by the Taliban. If you are willing to accept, please accept. We will be doing some conferences to discuss this thing. So this is what the principle has been proposed by the US, but this has been totally objected by Afghanistan president because he says involving Turkey in this process is totally unwanted, and we are not allowing Taliban to have a position in our government because as per the Doha agreement, as you have implemented your troops in Afghanistan, we have told you we are the president is the only sole person for Afghanistan government. So giving up the position to Taliban people is not good. This was told by the Afghanistan president recently. So the cabinet clears 74% FDI in insurance sector. So nowadays insurance sector facing a major income. To conclude it in a minor and more favorable to the people, government is incurring the foreign direct investment in insurance sector, which means it was 49% in previous days. So FDI in insurance sector was 49%, foreign direct investment was 49%. Now it has been increased up to 74%. To limit insurance sector comes with some safeguards. The majority of directors on the board and key management persons in the health and insurance general insurance companies would be resident Indians. So foreign direct investment may be 74%, but the majority will be Indian persons. At least 50% of the directors will be independent directors. So the insurance scheme sector will be monitored by Indian government, even though if it is 74% from FDI. The government will also specify a particular percentage of profits to be retained as a general reserve. What is the significance of the move? It will improve capital availability, as if it is insurance comes, the capital availability will increase when it is increased to 74% from 49%. Help in developing the insurance industry. Yes, we are having insurance sectors in India. So increasing the foreign direct investment in insurance sector will improve the insurance industry in India. And increase in competition in the sector. When FDI comes into India, the competition will increase and people will be benefited most usually. It would benefit small insurance players, such as ones where the sponsors don't have the ability to infuse more capital. So the small insurance company will be benefited. Improve insurance penetration in the country. Yes, it is sure when it is the foreign direct investment is increased, the insurance penetration will be more in Indian industry. So thank you for watching. With this we wind up. Let us meet you on tomorrow's session.